Happy Friday, Chris here, and I hope you're having an awesome day. And yes, mortgages, what? They went up, the Fed just cut rates. How is that possible? Well, because the Fed cutting rates is highly correlated to what mortgages do, but it's definitely not the end-all be-all. So how does that happen? How do we have better interest rates before the rate cuts than today? Well, a couple things. One, and I pulled up this great article from Housing Wire. Logan Montashimi is the author here. He's a great economist when it comes to housing. But he specifically talks about a couple things. One, housing permits came in better than expected. And housing permits is a very good sign for the economy. So if the economy appears to be stronger than expected, well, that's not good for mortgages. And also, jobless claims. Now, this is really the big one. So jobless claims came in stronger than expected, showing that the labor market is stronger than expected. So that is not good news for mortgage rates. And so technically, as of right now, we are a tiny bit higher than we were Tuesday or Wednesday morning. By the end of the day, we're still very close to a 2-year low. In fact, I locked in a first-time home buyer yesterday, 5.625, with just kind of standard setup, no big buy downs or anything like that. So that was really great. Not every loan is like that, but at the end of the day, still some really good stuff out there, particularly if you're comparing it to where we were just a few weeks ago. So one other thing I wanted to show you is the spread between the 10-year Treasury and mortgages. So people always ask me, well, are they going to go down more? My quick answer is yes. Yes, they will. Now, they will not go down in a straight line. Mortgages do not go down in straight lines. They go down in a very zigzaggy fashion. And we're seeing that today, right? We're seeing a little bit higher interest rates than we saw on Tuesday and Wednesday. But at the end of the day, the 10-year Treasury is really the biggest driver for how mortgages come up. So we have a 10-year Treasury, which you can see this is a 10-year Treasury right here. So, it was up really high, 4.7 before, and it's dropped off significantly. And so now we're about 3.6, 3.7 on that 10-year Treasury. Well, mortgages are basically the 10-year Treasury plus what we call a spread. Now, that spread is usually 1.75 to 2%. So if we had a 10-year Treasury at 3.6%, well, we very easily should have mortgages in the mid-fives, but we're not there yet. And it's because of this spread. So this right here is spreads on mortgages. And so if we're looking at this pink line right here, this is 2022, we can see we started at a 1.5 spread. So basically the Treasury plus 1.5, that was the mortgage rates. But you can see it climbed up, crossed over 2, and kept going up. And it's been elevated for now better part of 2.5 years. So this is 2024 right here, and the spreads are still pretty high. They're not as high as they were last year, but they're still kind of in that mid-twos. So when people say, hey, can you get better mortgages, Chris? Well, heck yeah, you can. One, we can just get back to normal, which would be a spread of 1.5 to 2% roughly. And then as the 10-year Treasury continues to go down, because it's highly correlated with the Fed rate cuts, we will see improvement in mortgages. And we could see some very significant improvement in mortgages if you combine these improvements in the Treasury plus the improvements in the spreads. A lot of good things can happen. If you have questions about financing a home, give us a call. Happy Friday.